Hit it.
It's Friday, June 14th, 2024, episode 241. I'm Patrick Serezna.
And I'm Kevin Muir. This week, we welcome Ben Rabidoux from North Cove Advisors. We have a fascinating discussion about the differences between U.S. and Canadian housing markets, where the opportunities lie, and whether the Big Short will finally work in Canada. Then lots going on in the markets these days, but thank goodness we have Patrick to read his magical drawings and tell us what he expects in talking charts.
And folks, stick around. We might even drink some beers along the way. Danny, hop on. What beer am I drinking today?
Today, you are drinking Erdinger Weissbier, which is one of my favorites. Classic wheat beer blends gently spicy malt aromas with mildly bitter hops. Very, very good.
Absolutely. You know, it's funny. I never tried it before. But it's delicious. All right. Kev, give us some side effects, bud.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the deflation denial, Powell pivot paranoia, or the Dudley dumps.
Oh, I suffer from that. All right. Let's get to the interview.
It's our great pleasure to welcome to the show Ben Rabidoux from North Cove Advisors. Ben offers a weekly newsletter that actually goes out to institutional investors that is about Canadian housing, macro, and credit. Ben, thanks for joining us.
Kevin, real pleasure to be here.
I've been looking forward to this for a long time. I've been watching you on TV. You're always the guy that I see when anyone's talking about Canadian real estate. It's always got Ben on. I'm like, geez. And you know, I was very happy when you said yes. And you were like, no, I don't think I can come on your show. I can't talk macro enough. But I really actually think that the Canadian housing market is an opportunity. But more than that, it also is something that's happening all around the world in terms of Australia is very similar to us. Do you feel the same way?
Yeah, I do. I think in some ways, Australia is maybe even more vulnerable to a housing downturn. But I agree 100%. What we're seeing in Canada, it's a story where highly levered economy meets rapid interest rate hiking cycle. It's kind of that simple. And that's not unique to Canada, but it is very acute here.
Right. All right. Before we start talking about all that fun stuff, let's get to know you a little bit better. You're Canadian. Where were you born, and how did you eventually get to this point with your newsletter?
Sure. So probably a pretty roundabout story, not a straight line by any means. I grew up in Stratford, which is a couple hours kind of west of Toronto.
Justin Bieber, for those
who
don't know.
Yeah, actually I knew the Biebs when he was a kid. And
really?
Yeah, randomly. So this is a crazy story. When he was like 3, I remember him being like the most gifted musician, even as like a 3 or 4 year old, like just unbelievably gifted. And I was like, wow, this kid is unbelievable. And years later, all of a sudden he's this like superstar. And people forget that he was actually like an amazingly talented musician. He isn't just this kind of
no, for sure.
Unbelievable kid. But anyway, that aside. So grew up there. I was telling you offline, coming out of high school, had good grades, but my one kind of criteria for figuring out where I wanted to go to post-secondary was where could I go and fish and hunt when I wasn't in class. so that like pretty much narrowed down where I could go. And I landed up in North Bay studying at a small university up there and doing a degree in human and environmental geography. And I did indeed hunt and fish my face off in between, and worked as a fishing guide during the summers. Still the best job I ever had. Yeah.
Most people, most kids, like they want to go skiing or do mountain biking or stuff. You're hunting and fishing.
I was hardcore hunting and fishing. And growing up in Stratford, if you know it, it's like rural. It's like there's farmlands all around. I'm like, man, I just got to get around water and trees. Right? So that's where I ended up going. Yeah.
So what's your favorite, before we go, what's your favorite fish to go for?
Man, I'm just like an equal opportunity fisherman. I love big muskie. Like I love salmon. I'm on Georgian Bay, so we fish a lot of salmon here. Man, I'll if it swims, I'll go after it.
I went one time with my brother and my dad. We went up to Lake Athabasca, and we went for some big. Yeah, we got some big Lakers, like 50-pound Lakers.
Oh yeah,
which is just unbelievable.
Yeah, that's a great
story. I got a quick story to tell you about this. So when we were there, I don't know if you remember the commercial for the banjo minnow.
Oh yeah, absolutely.
It was
like the Rage in the 90s. Yeah, it was like
for sure. Yeah. And it was like on all the fishing shows. Anyways, the fellow that made the banjo minnow was there at the lodge at the same time as us, and he was filming his next Banjo Minnow 2 commercial. And the fish were like, I think the ice had just been out for a week, and the fish were hitting everything. And we literally said, like, he's making this video and it's making it look like his lure is so great. And we laughed and said, you could literally take a spoon and put it out there and they'd hit it. And so we tied a spoon to the line and put it out there. And sure enough, the stupid pike were hitting that.
Oh, that was, I so remember that. It was like a late night infomercial almost.
Exactly.
Yeah, that was great.
All right. So from there, how does it, like, do you actually become a guide and do that? And what stopped you from being a guide for the rest of your life?
No, that was just a summer job to put myself through school, and I loved it. But coming out, finished university, ended up going back to get a master's degree, and landed teaching at Georgian College. My wife's a kindergarten teacher. I was teaching at the college, and kind of enjoying it. But I had this just a blog. This is going back to 2011, and had a blog. And back then, again, we were talking offline, like. Canadian housing and economic data is notoriously difficult to find and parse and kind of interpret properly. Very different than the US. We don't have that like neat kind of FRED system. And even back then, like the data that was on Bloomberg wasn't great. But if you had an academic affiliation, you had all access to all these great data sets. And so I was doing just simple economic and housing commentary even then, and had sort of developed this pretty wide following within the housing and mortgage community. Lots of discussion, almost became like an online discussion board in my comment section. And I started kind of doing like analysis, but then weaving in the anecdotes and the intel that I was getting from people on the front lines. It's like, well, this is what's happening in Vancouver, but Bob, the realtor, is telling us this, and this guy who's a developer is saying he's seeing this. And I didn't really understand at the time kind of how valuable some of the institutional investors found that kind of frontline intel. So unbeknownst to me, I kind of developed this pretty broad following within the institutional investor community. And in 2012, I get a call from a guy in California. And this guy was previously a mortgage broker during kind of the crazy time there, and had become a consultant to the hedge fund industry around the kind of, the Big Short, kind of US subprime. And he was very similar to me. He kind of knew all the players in the space, knew where the bodies were buried, and was doing similar kind of approach to me. And he's like, listen, all of my clients are reading your stuff. They're forwarding it around. Like, why are you doing this for free? And I had no concept of the industry. I had no idea people would pay for this. I'm like, what are you talking about? This is the hobby. Like, I'm doing this in the evening because I get nothing to do. And he's like, stop, just take it down and write it in a blog, like in a report format for me, and I'll run up the flagpole with my clients and see if there's an interest. And so I did. And like within a couple months, we had a distribution of dozens of these really well-known funds. And that very quickly spun out to my own firm, which is North Cove Advisors, and been doing that ever since.
That's a great success story. Then how typically Canadian that you needed an American to show you how to make some money off of it.
Yeah, it's embarrassing in hindsight how little I knew about the industry. Like, it just wasn't my world, right? Like, I had no idea.
Right.
But yeah, it was really kind of this guy to reach out and be like, quit giving this stuff away for free. What's wrong with you?
All right, so let's talk a little bit about that, because back then, you started in 2012, and I remember that period very well, because the U.S. had just had this terrible housing market. But our housing had actually, the U.S. had lowered rates and then come out the other side, we started to take off. Mm-hmm. And for the next kind of 5 to 10 years, it seemed like every single hedge fund in the U.S. wanted to short Canadian housing. And it was just shocking to me. I remember just everyone saying, oh, you're going to learn. And it just continued to rise and rise and rise and rise in their face. Now I find it kind of ironic because they've all seemed to be given up on it. I don't hear that kind of story at all. And yet it seems like if there was ever a time to get bearish on Canadian housing, it's here.
Yeah, it's I was sort of front line to kind of a long string of individual funds trying to figure out how to make money off this. And it's been a really challenging long-term trade. And to be clear, like there've been times where I've been pretty optimistic on the market and times where I've been quite pessimistic, but I'm a glass half empty kind of guy. That's my bias. And I've tried over time to kind of temper that and recognize that. But there have been times where I've been very optimistic on the market and actually pushed back on some of the bearish sentiment in the market. Now, today, I agree with you 100%. I think people are underestimating some of the risks. And, I'm a pretty good barometer for kind of sentiment internationally towards Canada. And, if I were to index kind of the interest in Canadian housing and kind of macro trades broadly, I would say it peaked in 2017, 2018 when Home Capital Group kind of blew up and was rescued by Warren Buffett. Remember that? Like that crazy fraud fiasco? Sure. Yeah. And it, if that was indexed at 100, I would say today it's like 40 or 50. So it's like half of the interest level that I saw then. And to me, it's way more interesting now.
You mean interesting on the short side?
Well, interesting in terms
of
everything that's happening. It feels like there's a lot of cross currents. Nothing's ever clean, right? And we can talk about the cross currents. There's some very solid underpinnings to the housing market that we can talk about. And so, these things are never clean, but in terms of like the times where something could really go wrong, like it's now more than ever. Do you know what I mean?
Okay. So let's start with, why don't you explain to people what has driven the Canadian housing market over the last 5-10 years and those strong underpinnings, like just kind of set the table for us of why we've done so well up till now.
Sure. Well, I mean, it's never one thing. So there's a whole slew of dynamics I think are at play, but kind of principal among them is we have seen to some degree an underinvestment in single family housing. We have seen significant speculation on the part of Canadians. We've seen the share of investor purchases rise from about 20% up to 30%, which and that's from kind of 2017 to 2022, which is akin to being about half of the incremental demand just coming from investors. And so you've seen this big participation in investment activity, speculation broadly. We've seen a big flow of kind of private credit that's continued to finance the marginal bid, even as the federal government and the bank regulators have tried to tighten up the traditional lending stream, which we can talk about. But I think the biggest one that everyone underestimated, myself included, was just the magnitude of the population boom that we would see. And really, like, that has driven so much of that has driven the speculative mentality among Canadians, because real estate can never go down because population's so strong, and it's driven so much of the rental growth that it's been the big story in Canada. And of course, that looks today like it's very much kind of in the rearview mirror.
Yeah, so I was looking, and you actually appeared in front of Parliament. Was this, or the Finance Committee? I was going through the records times. Here.
Yeah, actually. So here's a crazy story. So before you go too far down this rabbit hole, when we talk about immigration in Canada, and I know you want to talk about this at length, but there's kind of two parallel tracks. What we consider immigration is kind of a broad umbrella that describes both permanent residents coming here on a permanent basis, but then also temporary residents that are coming here as international students or temporary workers. And it's that second group that's really boomed in the last few years. And before COVID, so in 2019, we saw the non-permanent resident cohort grow by 200,000 in 1 year. And to me, that was crazy. We already saw that it was starting to have a big issue in the rental market. It was driving speculation in the resale market. It was having all sorts of externalities. I went before the Standing Committee on Finance in 2021, I think it was. And I basically said, because at that time they were trying to study the cost of living, and rent was a big input into the cost of living crisis. And I was saying, you just can't repeat that mistake. We need to be more thoughtful around the number of temporary residents that we have in the country, because they're all renters. So if you drop a couple 100,000 in a year, it's going to crush the rental market. And you fast forward to today, not only did they not listen, but it ramped up dramatically after that. And today we're adding 800,000 in a year. And so when you add on top of that the 500,000 permanent residents, it brings the total population growth to 1.3 million, or just over 3%, which is just a mind-boggling number. And that, to me, is kind of the root cause of a lot of the issues that we're seeing in the housing market broadly.
Right. So just for Americans that are listening, Canada is roughly a tenth of the size of America. So this is like them letting in 13 million people.
Yeah, that's exactly right.
Yeah, right. And it's just an absolutely mind-boggling number, as you mentioned. Now, I when I talk to people about this and explain to people this problem, and first of all, I think both you and I, we're all pro-immigration. We want people to come enjoy our country, but when we're letting so many in, we're neither doing them nor ourselves a favor because the country's just busting at the seams. They can't get doctors, they can't get dentists, they can't find a place to live.
Absolutely.
And they're just going to be unhappy. So we're not doing anyone any favors, but I would just want to say we are pro-immigration. We just want it to be done in a way that makes sense. My question to you is, what were they thinking? Like, what was driving this? Like, it just, in hindsight, it seems so obvious. And yet you just can't go from 0 to 1.3 million. And it just kind of boggles my mind. And do you have any kind of insights of why they did it?
Yeah, so there's a couple of dynamics at play. The first is that in Canada, there's some weird boundary issues around who's responsible for which form of immigration. So, for example, if the way it's traditionally been done is because post-secondary is a provincial jurisdiction, when the provinces issue a study permit, then the feds, they sort of have an agreement that the feds just rubber stamp it. Okay. And so what we saw for the last few years, we've seen this like proliferation in quote unquote colleges that have sprung up in Ontario and BC and other parts of the country, where in some cases just looks like this is like a small shop above a burger joint in some strip mall. Like they're not a college at all, but because people could come here, they could quote unquote study at these places, and then it was typically depending on whether they studied at one of those institutions or an actual accredited college, they would then get a guaranteed postgraduate work permit. Okay, and so it was a way to fast track into the work permit process, and then once they were here as with a work permit, then it dramatically increased the odds that they would get permanent residency. Because the way that we allocate permanent residency in Canada is it's based on what's called a comprehensive review, ranking system. So it's CRS, and so the bottom line is if you're younger, it scores you higher. If you have certain educational attainment, it scores you higher. If you've already been here on a work permit, it scores you higher. And so once you're already in Canada with a work permit, it's very easy for you to get permanent residency. And so people realized that there was a fast track to permanent residency by coming to Canada to study. And these for-profit institutions recognized this and then were hiring consultants to go out and recruit on their behalf and bring students here with this promise that you could quickly get your permanent residency. And so there was effectively no oversight. So in Canada, we have a target or a cap for permanent residency of a little under 500,000. But there was no cap, no target, no real oversight on the international student element. And that's what exploded in the last few years. And then concurrent with that, you had this very tight labor market. So we were bringing in a lot of temporary workers. You also had graduating students that were receiving automatic temporary worker diploma or certification. And so, they were active in the labor market. So it was just a lot of dynamics that kind of came together at once.
All right. So we have this huge boom, and it's something they haven't thought about. Do you think there was an element of as well, like it was helping the economy and they're like, well, maybe we shouldn't look too closely because the reality is it's making our growth look better than it is?
Well, it has to be. So, I mean, that's the interesting thing is, as you know, if you look at Canadian GDP in per capita terms, we've seen 7 consecutive quarterly declines. And really the only thing that's driving headline GDP growth is population growth. We know that productivity has been terrible. Productivity today is effectively unchanged from where it was in 2014. And we've seen, I think, 5 of the past 6 quarters have seen declining productivity gains in Canada. So, yeah, it's this weird thing where we're leveraging economic growth off of this incredible population boom. And we're doing as you said, we're doing a tremendous service to the people that are coming here. And not only that, we're allowing, like, it's a crazy situation because we're allowing citizenship to effectively be sold for profit by these for-profit entities who are out making these false claims on behalf of the government of Canada. And like, it's created a real pickle. We have 2.5 million non-permanent residents in Canada. All of them are expecting to get permanent residency. It's just not going to happen. And so the government is now realizing what a big mess they've created. And they're now trying to figure out how in the world can we unwind this. And to frame the scale of the issue, Kevin, like, we've seen some booms in non-permanent residents before. It actually bears a lot of similarities to the housing boom we saw in the late 80s, right? So in the late 80s, we had a huge housing boom in Canada, very tight labor market. We saw temporary residents rise from about 0.5% of the Canadian population all the way up to 1.5%. So over the course of a 5-year period. So big run up in temporary residents, a lot of them temporary workers coming in to fill this very tight labor market needs. Now, after the housing market rolled over in the late 80s, there was an interest rate hike, housing rolled over, the economy suffered, and you saw that cohort of temporary residents was cut in half over the next 5 years. And if you fast forward to what's happening today, we didn't peak at 1.5%. We got up to 6.5% today. Like, we're off the charts compared to any other period. And to me, the dynamics that have driven this population boom are highly pro-cyclical, right? They're tied to the strength of the economy. They're tied to the needs of the labor market. And they're starting to unwind. And not only that, there's now tremendous political pressure to start curbing this dynamic because people are recognizing it's not helpful. We're causing all sorts of negative externalities.
Right now, and you've spoken and written about this before, if we do have a situation where we go and start curbing that immigration and the amount of people, this is going to negatively affect the economy. And we probably, as you mentioned, we don't understand that the lack of growth is being hidden by this immigration. But now if we have a situation where immigration pulls back, we're going to have less growth in our economy.
Yeah, I think that's exactly right. And to put it in perspective, the government, I think, now recognizes the problem that has been created. And they've come out, and there's been a couple major announcements in the last few months. The first is that they are going to cut the number of study permits issued by 35% compared to 2023 levels for the 2024 academic year. But then they've allocated that across the provinces on a per capita basis. And so for Ontario and BC, it means that we're going to see study permits cut in half next year. So new study permits issued will be cut in half compared to last year. So that's a huge drop in kind of the flow of temporary residents coming to the country. That's the first thing. Right. But then second to that, we had the immigration minister, Mark Miller, come out and say, we're actually going to target reducing the share of temporary residents in the economy or in the broader population from 6.5% currently down to 5% within a year. Or I'm sorry, within 3 years. And so again, like people have they've sort of underestimated how much of our population growth is being driven by temporary residents. So if the government is successful in doing what they say they're going to do, then what it means is we're going to have to see a reduction in the number of temporary residents of roughly 200,000 a year for the next 3 years. So right away, you go from that cohort adding 800,000 to that cohort subtracting 200,000 within a year or so. And so you get a 1 million swing in the headline population growth number.
Right. So we go from 1.3 to just 300,000.
Exactly. That's exactly right. And so as soon as the immigration minister announced that, I said, holy cow, that's a huge deal. People are sleeping on this. Ran the numbers, sent it out to my clients and said, look, there's all sorts of repercussions related to this. But then it was interesting because then in the next Bank of Canada monetary policy report, they had done the exact same analysis and came to that same conclusion that, population growth is going to fall to 250 to 300,000. And I don't think that got any real attention. Like that is such a huge difference. That is, I mean, to go from 1.3 to 300 in the course of 18 months or however long it's going to be, that's an enormous swing.
It's actually shocking that the Bank of Canada figured out anything ahead of time.
You said it, Kevin.
All right. So let's talk a little bit about that's one aspect of something that's on the horizon for Canada that's not very good. But then let's talk about the difference between US and Canada and the fact that why our real estate market is more vulnerable than the Americans. And you've highlighted, the mortgages rates, the fact that ours is floating. You've highlighted the fact that we have more debt. Could you just talk about those two items?
Yeah, absolutely. So you're right. I think I have a pretty strong view that Bank of Canada is going to be forced to cut a lot more than the markets realize right now. And so here's a simple way to think about it. You're right. In Canada, unlike the US, we don't have 30-year fixed rate mortgages. By and large, the typical mortgage is 5-year fixed, and then it resets beyond that. But there's a sizable portion that is also shorter term fixed or variable rate. And what's interesting, if you zoom in on the variable rate for a moment, that's actually the the part of the mortgage market that's most at risk, but not for the reason that people generally think. So in Canada, we have a product that is a variable rate mortgage, but a static payment mortgage. And so, in other words, as interest rates go up, your payment stays the same, but less and less principal is repaid. Okay. Now, there's not a small amount of the mortgage market. You're talking about just under a third of the entire mortgage market is variable rate. And then within that, about, call it 70% are these static payment. And so, so here's where that matters. If you roll this forward, where rates are currently, as these loans renew, they reset to the higher rate, but then contractually they have to also reset back to the original amortization schedule after the 5 years. Okay. And so that creates this kind of double whammy of payment shock. And so if you roll this forward based on the work from the Bank of Canada, what they show is come 2026, you're going to have, for that cohort of fixed static payment variable rate mortgage, the median increase in payments at renewal is going to be 60%. Wow. So you're talking about 20% of the mortgage market.
Is 6-0?
Yeah, 6-0. So in other words, by my math, that's 20%-ish of the mortgages outstanding are this static payment variable. And the median payment increase is going to be 60%. So in other words, you have 10% of borrowers that are going to have more than a 60% payment shock. That's just not manageable in my mind. Now, you can push back and you can say, well, we've seen some signs that so far Canadians have managed, the ones that have the true floating payment variable. So for example, like BNS and National Bank, their borrowers by and large they have floating payments. So it's in one sense like they've already kind of stress tested it, and we are seeing rising arrears that are outpacing kind of broader market within that borrower pool. But it hasn't been disastrous by any means yet. But man, I just think when you get that sort of a rate shock, it's just going to bleed out in weaker consumer spending and in weaker housing. It's going to be really problematic for the economy. And just to close the loop, because most mortgages are on 5-year terms, right? If you think back, like we had a huge boom in originations in 2020 and 2021 and into early 2022 when mortgage rates were super low. And for a period of about 18 months, we had variable rate mortgages in Canada that were in around the 1% range. So you get a mortgage for 1%. And those mortgages are going to be, they're the really problematic ones. And if you look at the renewal schedule, we have a fairly light year in 2024. It's about, call it 15% of the overall mortgage market is renewing. And then it jumps in 2025 to about a quarter. And then it's like 35% in 2026. So you have 2 years of very high renewals in 25 and 26, which coincide with kind of lapping that 5-year gap where rates were ultra low. Do you know what I'm saying? So those loans that are renewing in 25, 26 are going to be these like 1% vintages from 2020, 2021. And right. That's why the change in payments at renewal are so sharp.
And this has got to be something that the economy, like, it just won't be able to handle it. So one of your forecasts is that the Bank of Canada is going to be forced to actually lower rates quicker than most people expect.
Yeah, I don't really see how they're going to avoid that. And there's a lot of things kind of coming together on that front. I do think the mortgage renewal dynamic is a big one, but you're also just starting to see broadly like a lot of softness in consumer spending, a lot of softness in discretionary expenditures. You're starting to see that the consumers are just buckling. And I have a view that, again, like my kind of bread and butter is I look at the economic data, but then I really mesh it pretty well with people who are on the front line, the practitioners in the space. So I'm talking regularly with insolvency trustees, developers, mortgage brokers, realtors. I mean, kind of the tip of the spear in kind of, housing and economic activity and consumer credit. And man, all of them are just like in the last few months, just like, man, things are starting to break. And I don't think it's being fully reflected in the economic data, just the pain that these rates are starting to cause. And I've had a view for a while. It's always dangerous when you put like short timelines on certain projections. But man, I've said for a while, I think by the end of the summer, maybe into the fall, like it's going to be pretty clear, I think, just based on the conversations I'm having, that things are starting to really break in Canada. And I think when that happens, we're probably by the end of the year, we're going to start talking in more like Not do we need more cuts, but more like, is 25 basis points at a time going to be enough? That's where I think we're going. Yeah.
Wow. I watched one of your interviews and you talked about the fact that people are always good at treading water for a long time. I completely agree. What's that line about economics? It just takes forever and then it comes all at once. And all I could think about is when you said the treading water. Do you remember the Magnum PI where you had to tread water for 24 hours?
Man, nope.
You're probably too young. You're too young.
No.
There was a famous Magnum PI episode where he treaded water for 24 hours. Anyways, one of the things that you missed there in terms of not only are Canadians faced with interest rates that are more variable, we are also faced with much more debt than the Americans.
Yeah, I think that part is pretty well known. Like, I think there's some elements of the story that most people understand. Yeah, Canada broadly is a highly levered economy, and right. Much more so even than people realize. When you aggregate all private credit, you're looking north of 300% of GDP. Like, we're well above where the U.S. is, and we're one of only a handful of countries. If you look at the BIS numbers, we're one of only a handful of countries that is above that threshold. So, and the thing is, people are always looking at the federal government debt levels and they're like, well, we look pretty good internationally. But of course, in Canada, we offload expenditures like education and healthcare to the provinces.
Right.
Right. So they have massive debt burdens. When you aggregate that on top of it, and then you look at private corporations, you look at the households, and you aggregate it all, we're a very levered economy. And what I think is interesting, like if you look in the US, so, they've got the 30-year mortgages. Coming out of the financial crisis, there was a deleveraging that happened. They paid down debt. They defaulted on some. So households are in pretty good shape. If you look at the household debt service ratio, the U.S. is still near all-time lows at the same time that Canada is sitting at all-time highs. So we've never seen as wide a gap in the debt service ratio. So one of the points I've made for a while is we're fundamentally at different points in the monetary policy cycle between Canada and the U.S. We have to, right? And like the Bank of Canada cannot out-hawk the Fed. Like they can't. There's no way they can hold anywhere close to the Fed because these rates are just not hurting U.S. households and U.S. businesses yet. And it's really hard to get to a scenario where the U.S. starts to crack first before Canada is kind of already well down the path towards a nasty recession. I can't get there. So I just think the Bank of Canada is going to be forced to move. It's going to get vetted through the currency. That's actually going to facilitate a lot of the adjustment that we need in the economy because we've spent way too much time in Canada investing in housing, in unproductive endeavors, and not nearly as much capital has been spent on trying to build out productivity. And we need lower rates to help facilitate that adjustment.
Yeah, I've been in the same boat as you are. I've been saying this for a while. For everyone who got bearish on the U.S. economy, I said, if you're bearish to U.S., well, you know what? You should be shorting Canada with both fists because the reality is that everything you're worried about in the U.S. is way worse here in Canada.
Yeah, 100%. I think that's exactly right. That's bang on. It's just there's so much more leverage. It's so much. It comes to a head so much quicker. We have much more speculation. There's just a lot of issues at play that are just not there in the U.S.
So, Ben, one of the things that I've been saying for a while is that Tiff is one of the worst central bankers out there. And part of the main reason is that he keeps thinking that the American economy is like the Canadian economy. And I think they're much different. And I'm going to go back to a quote he said back in July of 2020. He says, if you've got a mortgage or if you're considering making a major purchase or if you're a business and you're considering making an investment, you can be confident rates will be low for a long time. It's unbelievable. You quoted that tweet. That is an unbelievable thing to say.
Yeah, you couldn't time that any worse. And within a year, we had a raging inflation problem, and he was rug pulling everybody. Yeah,
right.
I mean, whatever. It's tough, man. Like when you're looking in hindsight, that was a crazy time, and we were looking at the economy on the verge of a Great Depression, but man, that's terrible. That's never going to age well.
But this is the problem with him right now, though, is I think that, yes, he finally went and he was the first G7 bank to cut by one day. But he really should have been cutting 6 months ago. You have to skate to where the puck is, not where it will be, not where it is. And he's just skating to where the puck is.
Well, and the other thing you got to remember, like when you look in Canada here, so unlike most economies, we include mortgage interest costs in the CPI, which is a crazy, that's just, to me, that makes no sense. You end up with a situation where the Bank of Canada is chasing its own tail. And that's not a small dynamic. Mortgage interest costs alone are still adding 0.6 percentage points to headline CPI in Canada. So you back
Right.
that out, and we've been at 2% target for about 6 months now. So you're right. I agree with you there. The other thing I would say is, like, man, you start looking at like business insolvencies in Canada. Man, that chart's starting to look scary. You start looking at consumer insolvencies really trending in the wrong direction, but it's still only now back to kind of normal levels. But the business insolvency looks scary. The trends within the labor market, when you start looking at like the really cyclical components, they're starting to look really soft. Construction employment, like the stuff is there where you say, okay, you roll this forward a few months, this is going to start really manifesting in a weak economy. And I agree with you. Bank Canada should have been cutting this months ago.
Right. The other thing that some of the bulls might say in terms of when the Canadian bank bulls, which seems to be Canadians all around, are always bullish on our banks, but they might say, oh, but don't worry, the banks have already provisioned for all this. You had a kind of an interesting stat and kind of observation about the pre-builds and the fact that we have this kind of speculation almost in like condo futures. Like that's what it seems like. Explain to people the dynamic there and what's happening and why that might actually be a problem for the banks going forward.
Yeah. And let me preface this by saying I don't put myself out as a bank analyst at all. So to the question of whether they're provisioning adequately, I have no idea. But what I can tell you is I don't think people are giving enough thought to the risk that's in the pre-construction condo market. So let me frame it. For years now, because of the popularity of investing in pre-construction condos, developers have priced those at a premium to resale. And so when we say pre-construction, we mean literally a unit that has not even started construction yet. You're going to enter into a contract to purchase this when it completes 5 years down the road. Okay. And by and large, most buyers had no intention of actually occupying it. They were speculators. They were going to assign that contract to another buyer prior to closing. And it's effectively, it's just a levered play on appreciation. And this is why this is understood to be the vast majority of pre-construction condo sales were going to speculators. Okay.
Right.
Because of the popularity, developers figured out that they could actually bake a growing premium in that prices, in the pre-construction price relative to resale prices. So in other words,
so batty like that.
Oh, dude, this is crazy. So in other words, this is not new, right? So this has been the case for over a decade now, where there was a premium, but it used to be that it was like 10%. And then when things got really crazy in late 2020 through to early 2022, there were a number of condo projects that were selling at 25, 30% premium to resale, and like comparable new build resale in the same area. So now you roll forward. Okay. So
just to explain to people what this means. So that means that you had something that was trading at $1,000, per foot, a condo, the pre-construction for right beside it would be trading at $1,300.
Yep. Yeah, exactly. And so what this means is when it comes time to close, the original pre-construction condo buyer would have to qualify for a mortgage. Now, if the resale values had not risen enough to justify the pre-construction price, then there would be a deficiency in the appraisal. So the bank, in other words, the bank would say, well, look, you've agreed to purchase this for $1,300 a square foot or whatever, but in reality, the resale market's only $1,100. So we'll give you 80% of $1,100, and you got to come up with the difference. So effectively, they're going to face a capital call at closing. Now, we actually went, so a good friend of mine and myself, we're trying to roll out another research offering that's kind of parallel here, that's tracking just this dynamic, because I think it's such a big dynamic. And we actually tracked all the major condo developments under construction across the GTA, and we looked at the per square foot price that they were sold at pre-construction and our best estimates of what the current comparable resale value would be. And then we plotted them on an axis where going forward, you look at, okay, what's the completion schedules in each year and how much are they kind of in the money or out of the money? And you end up with this downward sloping line where over time they get more and more deeply negative equity. So in other words, you roll out to 25 and 26, we're going to have a pile of condos that are completing that are 25 to 40% offside because the resale market has moved against them.
Wow.
And so I'm telling you, like, this is there's a lot we could talk about here, but I don't think people have given enough thought to how big a problem that is. And there's no easy way out. People could say, well, the developers, whatever they have the deposit. Okay, fine. So they can take the deposit and try to resell it. But you get into these other weird dynamics where in Canada, you have what's called an interim occupancy period. So your unit is finished, but the entire building is not yet finished. And so they can't register, they can't create the condo corporation, but you have access to your unit. So the first thing all these investors are going to do is they're going to put a tenant in there. So now if the developer, if these people can't close, or if they start to walk away en masse, developers are stuck with units that are tenanted. Like,
God.
Have you figured, and like, has anybody spent any time looking at tenancy laws in Canada? Like, that's such a disaster. And so, I think we have a serious risk where some of these buildings will be unable to form a condo corporation. And if they're unable to form a condo corporation, the banks don't get paid. Right. And then it just becomes like they can't repay the development loan. Do you know what I'm saying? Like, you need to be able to form the condo corporation, close all the units, and then repay the loan. And like, what investor is going to close if your unit is 40% offside? Like, to me, it's just a major issue.
Yeah. It's shocking that, well, first of all, the premium is just shocking, but it shows you how well the market was doing, that was the people felt comfortable speculating with that sort of premium. Like, that's
well,
just
and not
insane.
only that, Kev. Yeah, I know that, but it tells you they were all investors, because no end user is going to buy a unit at a massive premium and they don't get to live in for 5 years when they can buy one across the street and occupy it tomorrow at a 30% discount. Do you know what I'm saying? It was all investors. And now, and not only that, like, man, I'm telling you. So again, talking to the frontline contacts, I mean, I'm talking to real estate lawyers right now, and they're just shaking their head. They're like, this is like every day, all day, every day, I'm getting calls from these people trying to figure out how to get out of this contract. They're like, you cannot get out of it. You have to just walk from your deposit and see what the developers do. And so, like, this is just starting. Yeah.
And in Canada, we don't have non-recourse loans. So, like, theoretically, the developer can still sue the person, right?
Yeah, they can. It gets a little tricky in terms of, like, it's feasible if it's a handful of borrowers or buyers that don't close. But if you've got like 300, does the developer have the resources to that's millions of dollars in legals to try to do that in years? Do they have years? Right. And then it gets even more complicated when you get developers that have very explicitly marketed to offshore buyers. Like, there are major developers, some that have actually gone underwater already in Vancouver, where it's been known for years that they've had sales offices in Hong Kong. Have fun trying to collect on a non-Canadian citizen living in China. Like, good luck with that judgment. You know what I mean? So, there's some nuances to that discussion, but you're right. There's an element of recourse there for sure.
So this paints a pretty bleak picture for Canadian real estate, especially in the coming years. And one of the things that you've been highlighting is that it'll be offset by a Bank of Canada that is forced to actually go and lower rates. And this is part of the reason that I was always kind of pushing back on my American friends that would say, Canadian banks or Canadian real estate is a huge short, is that maybe the outlet valve will be the dollar, the Canadian dollar. And I just love to hear, I'd love to hear your thoughts about that. And then recently you've been talking about the fact that you think, although that will be an outlet valve, you're worried it could actually become such an outlet valve that it creates problems and they won't be able to release enough steam, in essence, because of the spread on the dollar.
Yeah, so you're right. That's always been my view, is this gets fended through the currency. Now, I wouldn't say that I think, like, look, again, my experience talking with folks in the lending industry, so mortgage brokers that are originating on behalf of the banks, I mean, I have a really strong view on things like the prevalence of mortgage document fraud in the Canadian lending ecosystem. It's way more prevalent than I think people realize. Look, I think there's more risk to bank balance sheets than people generally give them credit for. So it's not that I don't think there's some problems, kind of some bodies buried there, if you will. And I think some of that's starting to come to the surface. You saw TD get slapped for, anti-money laundering. Like, my view for a while has just been that Canadian bank regulators are more or less asleep at the wheel to some of the stuff that's been happening.
Right. And actually, but let's talk a little bit about that before you go further with the dollar, because you brought it up. You highlighted on your Twitter feed the other day the fact that BMO got in trouble with, in terms of the Canadian regulator, for some sort of document issue in terms of mortgages. And the same thing, BMO gets a slap on the wrist in Canada, and then in the US, TD is in trouble for essentially the same thing. And
well, it was actually TD in both cases.
It was.
TD in both cases.
I thought it was BMO. I'm sorry.
No. So BMO, that's a different issue that I quoted about. But that was more related to just like what should be blatantly obvious as money laundering, and they didn't. There was nothing done. But anyway, that's a separate story. But no, in TD, so FinTrack are a regulator that's meant to sort of monitor money laundering in any sort of questionable transaction. They slapped TD with an $11 million fine. At the same time that the U.S. regulators are looking at potentially a $4 billion fine. Like, it's just not, I mean, that's just, to me, that's in the Canadian regulatory apparatus is so broken when it comes to banking and mortgages. People just have no idea. And again, like my interactions with folks on the front line, there's so much stuff that's happening that's an open secret. And the regulators are asleep to it. Like, Kevin, I was involved with busting $1 billion mortgage fraud in Canada. Like, I was sued personally for defamation. Those guys today are on trial for fraud. And I was literally taking this stuff to the mortgage regulator, like trying to get them to shut this down. And they didn't. And it was happening in plain sight. And so that's one example. And so the money laundering, the mortgage document fraud, I mean, it's all, you talk to people in the industry, it's an open secret. The regulators are blind to it. But even when they do find it, it's a slap on the wrist. An $11 million fine for money laundering when their U.S. counterparts are levying a $4 billion fine potentially. I mean, it's crazy.
Right. But one of the things that you've highlighted is the fact that the mortgage industry group is actually almost begging government for more restrictions. And one of the things that you say they've recommended is direct income verification. Yeah. Explain to people what that is, and then why that, if that happens, it would be actually a shadow credit tightening.
Yeah, absolutely. So again, getting back to things that I think people are underappreciating, I think mortgage document fraud is a widespread and pervasive issue in this country. And I can talk at length about that, but I would encourage any of your listeners, if you're interested in this topic, CBC actually did an undercover investigation on this, and it's mind-blowing. So just Google CBC mortgage document fraud. Okay, amazing clip, like a 20-minute segment on it. So that's been happening forever. It's widespread. It's to the point now where even the mortgage lobby, the industry group that represents the mortgage lenders across the country, is begging the government for direct income verification for Canada Revenue Agency. And in the U.S., they already have this. So if a borrower walks in and they say, "Here are my tax documents that prove my income," in the U.S., they can effectively verify the income with, I don't know, the IRS, whatever the entity is. And so in Canada, what they're trying to do is figure out how to create a portal where Canada Revenue Agency can just simply say yes or no to whether the claimed income on the tax document matches what they have on their files. That's all they're trying to do.
Just a quick question about the U.S. Is this something that was done post-GFC?
No, my understanding is it's been there for 20 years. Now, again, one of your listeners might correct me, but I spoke to a senior person in the lending industry here in Canada, and they said this has been something that's been placed in Canada or in the U.S. for 20 years.
Okay.
So there's no reason not to have it in Canada.
Right.
And it's a pretty simple, elegant fix to the whole thing.
Right. So let's assume they do that.
Yeah,
again.
I think they will. I think
Right.
that the political pressure is such that they will. And when they do, I think it's a much bigger credit tightening than people realize. Because if I'm right that mortgage document fraud is a pretty chunky part of originations in this country, you're going to see it show up. And it's actually, Kevin, it's actually such a simple fix that the fact they haven't done it yet tells us that either they are so clueless to the issue, or that they recognize that it actually is such a big issue that it's going to be hard to put back in the box. Do you know what I'm saying?
Yeah.
Like it is one or the other, right? And so now you're at the point where you have the industry group pushing the government to do this. You have the Standing Committee on Finance recommended that the government do this. And in the most recent budget, the government came out and said they're going to look into this. So I think it's coming. It's probably going to be later this year or early next year. It'll be announced, and we'll see if I'm right. If they roll this out and there's no meaningful issue in Canadian lending and in home sales, and like I'm just wrong on that, man, I don't think I am.
Right. All right. Now let's go back to the outlet valve. So we all probably agree that Canadian real estate market's in probably in some trouble in the coming years. And one of the ways that it'll be fixed is by the Bank of Canada lowering rates. Now, one of the issues is there's only so far we can lower it versus America. Why don't you speak to like what you're worried about there?
Yeah, well, I just think that ultimately the Bank of Canada needs lower rates. They're okay with a lower currency to a certain extent, but they do run the risk eventually of creating inflationary impulse from the weaker currency if they let it go too far. And that to me suggests that eventually they may get hemmed in. This is kind of like the nightmare scenario for Canada, where the Bank of Canada, the domestic economy weakens significantly, but the Bank of Canada is somewhat constrained in terms of how low they can cut because the Federal Reserve needs to maintain a much more much tighter monetary policy to kind of stem inflation stateside. That's kind of the nightmare scenario for Canada because we get forced into higher rates and even as the domestic economy weakens. And so that was always like a hypothetical that was out there because the U.S. and Canada are at different points in the monetary policy cycle. The vulnerabilities in the household lending ecosystem are so much greater in Canada. But now it seems like that's like a very real possibility.
Yeah, like I've said, I think the Canadian dollar is going down to all-time lows. Do you feel the same way?
I 100% agree. I think we're going to retest. Yeah, we'll get into the low 60s. I think. I don't. Again, who knows? But certainly that's what we're going to need. Now, what's interesting, Kevin? So you go back to the last time that the U.S. dollar got that low. It was in the aftermath of a housing downturn, and very similar setup to today. You had a big run up in prices, lots of speculation, big boom in population. It turned out that temporary residents, a bunch of them left. Population growth got hammered. The currency got decimated. But what's interesting back then, and that's different today, is we had like a massive, powerful manufacturing sector that responded very favorably to those lower rates and roared back to life and effectively absorbed a lot of the excess labor that came out of the construction industry. And that's the one thing that I worry about today is like we don't have that in Canada. So like, yes, we can crush the currency, but there's no easy flow through outside of, as you've identified, some of the resource industries in Alberta. But in terms of like central Canada, there's no easy way for lower currency to stimulate the manufacturing sector that is half of the employment that it used to be.
That's a great point. I haven't thought about that. Basically, we're going to need everyone to move out to the oil sands. And why don't you talk about that? Because I do agree with you. I saw you highlighted that one of the beneficiaries of this lower currency is going to be Canadian resource companies.
Yeah, if we're right, if the currency goes lower, and if we're in an environment where resource and commodities kind of hold their value or even go up a little, yeah, I mean, there's just a lot of companies that are going to print cash out in the oil sands. I like it a lot. I think that makes a ton of sense. They get the benefit of the currency lift, and the balance sheets look good. Like you've articulated it probably better than I can, but it's a pretty interesting opportunity if we're right on the currency.
For sure, because you get a situation where you have these assets that are such long life in terms of the oil sands. There's tons of life there, and you're selling in U.S. dollars. And your costs are all Canadian. It's going to be unbelievable. They're just going to print money. And I think the other thing I was interested in is I was shocked at how much gold we actually produce. I had no idea. I saw some stat about this and I was like, oh, geez, I had no idea that we were such a gold producer.
I didn't realize that. I know the Bank of Canada doesn't have any. Maybe they can sell.
Well, I actually wonder. I think part of the reason that they said that they didn't have any was because we were such a big producer, so we didn't need it as much. All right. So one of the other things is if we are right about the dollar, and not only that, if we're right about the economy, one of the things that you worry about is inflation, and obviously that's something near and dear to my heart. I tend to agree with you that we are going to be struggling with more persistent inflation in the coming years and decades than we think. Why don't you walk us through why you might believe that as well?
Well, I think in Canada, in addition to the currency issue, and I do think that at some point the weaker currency does become problematic for the Bank of Canada. We do start to import some inflation, but I think broadly, like I don't have any unique or novel insights on this, but I think broadly I'm pretty sympathetic to the view that we're entering an era where you're going from globalization to some element of deglobalization. We're trying to onshore our supply chains. You're trying to move away from countries that we're now recognizing as being a little more hostile. Massively inflationary. And I think in concert with that, we've seen just a dearth of capex in some of the more cyclical commodity sectors. All of that to me just looks like it sets up for an inflationary dynamic going forward. Now, one of the interesting tells in Canada is the government of Canada very quietly stopped issuing real return bonds, which I do wonder if they aren't recognizing that one of the ways out of this, and for your listeners, the real return bond in Canada is similar to TIPS in the US. It's an inflation protected government issued bond. And you do wonder if the fact that they stopped issuing those, as I recall, in late 2023, and very, very quietly to very little fanfare, very few people kind of caught that story. You do wonder if the government even is recognizing that one of the ways that we're going to have to facilitate a readjustment in a deleveraging across the economy is to let inflation run potentially a little bit hot for an extended period of time.
Yeah, I'm completely with you. I'm being fascinated by the fact that they've issued them in the first place. Why would you want to, basically short sell inflation?
It's crazy. I agree with you.
It's been absolutely one of the craziest things around. The other insight you had the other day that I thought was really interesting was you talked about after you go through a credit cycle, the regulators always layer on restrictions to make it hard to make money for, the coming years after. We saw that very much with the US after the post GFC. They clamped down on all the banks and it made it so very difficult. If we have a situation where we do have the mortgage fraud that you're anticipating, are you worried about that occurring in Canada as well?
Oh, absolutely. I think that people are sleeping on this issue as well. Like, you're right. In the aftermath of a crisis, the regulators are always keen to look like they've done something after the fact, and it becomes just death by 1,000 cuts. It's just like there's just all these massive headwinds to growth, and so it's not hard to envision, for example, a scenario where once CMHC, which is our crown corporation that insures a bunch of mortgages, they insure about collectively on the bank balance sheets, about 30% of the mortgages are insured. And so the default risk is transferred to another entity. Now, in a scenario where we start seeing rising losses and this mortgage document fraud issue starts to come to the surface, you do wonder if the insurers aren't going to be incentivized to go back through those originations with a fine-tooth comb and put back anything that was not underwritten properly, especially if you get a different government in place. And you look at who's leading in the polls right now, and by all accounts, from the people who are close to the Conservative leader, it sounds like he's setting up to be a little more antagonistic towards CMHC and towards the banks. And so I can easily envision a scenario where, CMHC, all of a sudden things like risk sharing is back on the table, where all of a sudden the banks are forced to pay a deductible on claims and they're put in first loss position, which I think they should have been put in all along. I absolutely think that's going to be on the table, and it'll be a scenario where, to your point, the regulators look to be seen as having done something after the damage is already done.
What are the chances that the Canadian government stick handles through this without a major problem in the real estate market?
Well, I mean, there's a chance, and what's tricky, and we talked at the beginning about that there's very real cross currents here, right? So, for example, I'm very worried about the condo market. I mean, I see a lot of issues brewing in the condo market. When you get into single family building permits are at 40-year lows nationally. You can make the argument that for the next 18 months, 2 years, whatever it is, we're going to have a very demand-constrained housing market. But beyond that, whenever the cycle turns, there's just not going to be a lot of new supply on the single-family space. And so there are offsetting factors to all this. I'm still on balance. I'm very concerned about what I see in the market, but it's not like there aren't some underlying long-term supports here. So can the government stick handle for a few years to get us through this? Like, yeah, maybe they've done it so far. I mean, they've managed, to their credit, to avoid what I thought would have been a housing issue years ago. But man, if it was ever going to happen, it's going to be now. And if not now, then kudos to them. They've managed to stick handle it.
Okay, Ben, it's been just a pleasure having you on, but I can't leave without asking you a few questions, and I did not prep you in advance. So, as a Canadian, I thought I would give you some Canadian questions, and they're just going to be fun. We'll start with your favorite Tragically Hip song.
Oh, Weekend.
Okay, that's a good one. And greatest Maple Leaf?
Oh man, you know what? Not greatest in terms of goal scorer, but I always love Ty Domi.
That's a good one. For those who don't know Ty Domi, he's a scrappy kind of fighter kind of guy.
Little guy who just punched way above his weight. Yeah.
And final thing, how do you take your Tim Hortons coffee?
I'm just a 2 milk guy.
2 milk guy. There we go. All right. So for those who want to learn more about Ben, first of all, I think you should go grab anybody on Twitter should go follow him on Twitter. So it's Ben Rabidoux and it's spelled BenRabidoux. So let's get to those people following you on Twitter. And then for those institutional clients that are want to learn more about your service that you offer for institutions, how do they contact you?
Just send me an email, Ben at northcove, northcove.net. And I will gladly send out some sample research. And if there's a fit, we can discuss from there.
Great. Well, Ben, thank you very much for being on the show. It's been a real pleasure getting to know you.
Thanks, Kev. It's been a pleasure.
Thanks. All right, Patrick, as we mentioned, lots going on in the markets these days. What do you have in talking charts?
All right, well, let's just go through the top 3 things we were watching a couple weeks ago. There was central banks and European elections, and actually European elections ended up being a bigger deal than we originally thought.
Well, I was probably the one poo-pooing that.
Yeah.
And it did. It was a big surprise. And then France ended up calling a snap election. And if you actually look at the charts, are we going to talk about those charts?
I would love to. I'd love to talk about the Euro charts. Actually, we should take a broad look at the equities. We can, but even the bond markets in France are moving. And so lots going on. But the FOMC was really interesting because when we got actually, we might as well just talk about those inflation numbers and jobs numbers were the top 3 things to watch. We might as well talk about them all together because the CPI came out. And obviously, when you have inflation come in and below expectations, the first instinct is for that it's going to spur Powell to act sooner, and that the market was going to pull forward the rate cuts that could potentially happen, or at least increase the probability that September happens. But Powell came in and stayed the course. I mean, I think that was a dot plot saying 2 cuts this year still.
No,
what's your take on it?
The median dot plot went to 1 cut, and it ended up being somewhat of a hawkish presser in terms of the FOMC. The real problem, Patrick, is although we finally had a CPI that came in a little bit lighter, we have to remember that the previous 3 were all way hotter, and then the jobs number again was stronger than everyone expected. So It's like we can't get both of them weak, which is what they kind of need, and they need to see a month or 2 of that. They can't just be one economic release. So we have a situation where they're still on hold. And I think that the kind of consensus was that this shut the door for July, and it made September a lot tougher.
Absolutely. All right. So I want to talk about the European charts in a moment, but let's talk about the top 3 things to watch in the next 2 weeks. Kev, I had to put it in there. The U.S. dollar.
I'm surprised it's only number 3.
You know what? I did want to. I was tempted, dude. I really was. But wanted to just highlight, though, it really, I was actually in the position where I thought the dollar could stay in the doldrums, like just summer doldrums, just trade range bound. But Europe really woke it up. And while this Dixie chart has a breakout candle, it's truly most evident when just looking at the breakdown in the euro itself. It really has worked its way right back down towards the year lows. and it really feels like at this stage there's not much stopping it from heading back to the October low near 105. And the euro is such a huge component of in the dollar index that the shit show in Europe is potentially going to spur some dollar strength, especially by the way, how much do you think it's the elections versus how much do you think it's the fact that the Fed is a little more hawkish and versus Europe's already cutting? Do you think it's the
No, I think it's the elections. As opposed to,
we know the elections was a component, but
I think it's the main driving force of what's happening in the euros and the euro for the last couple of days.
Absolutely.
All you have to do is what I was going to mention is go pull up the French stock market. French stock market is getting absolutely destroyed.
Yeah. Well, let me see if I
the CAC.
Yeah. And
there it is. I see it.
Yeah, just a hammering on the downside. I mean, that's basically in the last month it's down 10%, but just in the last 2 days it had a steepest part of its drop, about 5% in 2 days.
Yeah, that's getting to be a real correction. In one of my plugged in groups, the guys were telling me that the Swiss money managers were just pasting it out today on Friday.
Right.
They're just selling in big time.
And the interesting part is that when you look at the euro stock itself, this is actually, we'll come back to this because I want to. This was about the dollar. We're going to come back and talk these charts a little bit more detail in a moment. So number 2 was the inflation numbers. We already saw CPI and PPI, but the core PCE is coming out towards the end of the month before we do the next episode, and that continues to now be a focal point. And is there something you're particularly watching?
Well, no, you always need to watch core PCE because although the Fed does watch CPI and PPI, and although we trade mostly CPI when it comes to tips or inflation swaps, the reality is that the Fed bases their policy on the core PCE. So that's, at the end of the day, that is what's driving the Fed. So you need to watch it.
I remember us having this conversation 2 weeks ago, and the thing that I distinctly remember is us talking about the fact that with oil and gasoline having trended down, it's really hard to imagine that inflation was going to be upticking on a month-over-month basis. And so it did come in soft, but the question really becomes, what's the backdrop for the next surge of inflation? Or do we see a sequence like going towards even the end of the year where it's just disinflationary, not necessarily deflation, but just simply that this is not where the surge happens. And maybe it's really a 2025 story.
I think it's going to be difficult because it's going to depend a lot on what the financial markets do. I think if we had a situation where all of a sudden the financial markets got into trouble, let's just imagine, I know it's tough to imagine, but let's imagine that AI spending started to slow. And you got a huge, sell-off in those stocks combined with some widening of credit spreads and some just kind of general risk off. And if we had a situation where employment upticked a little bit, I think that the Fed wants to cut, the Fed would cut. And so therefore, what occurs after that cut? Is that then the cut that spurs everyone to rush into oil, rush into the commodities, and those things scream again? And that's the really difficult kind of thing to judge.
Yeah. So the number one thing to watch is AI.
Oh, it's Patrick. This I've been telling all my readers and in my chat group. I said timestamp. This moment in your mind. This is unbelievable how much these 3 stocks are rallying. And the kind of the narrowness of the range. I saw this stat about the S&P equal weight versus the S&P.
Yeah.
The correlation was at all-time lows, meaning that,
absolutely.
Yeah, there's just, and when you go,
actually, you're going right into the topic that I wanted to actually discuss, so we can dive deeper in this because the breadth of the market is truly divergent.
Yeah.
You're basically having the majority of the market not participating, and the thing is that now Nvidia, based on rules of symmetry and things like this, is finished measured moves. Apple had that big surge, just one of the big market cap participants in this whole thing.
One second, can we take a moment to talk about that? Because let's just stop and think about this. This is one of the world's biggest stocks, and it's trading like a meme stock in terms of those past.
No, it's not one of. It is the biggest, right?
Microsoft was at the time.
Yeah.
But now it's funny because all three are super close: Microsoft, Nvidia, and Apple. And the other interesting thing about this, in terms of all this game theory, I don't know if you've been paying attention, but this XLK has to rebalance if the Nvidia ends up being higher than Apple at the kind of today's close. And it's like, I can't remember what the number is. It's like $10 billion of like Apple to buy or Nvidia to buy and Apple to sell. So it's quite a horse race in terms of these three stocks. But that move in Apple, Patrick, is just breathtaking because that's I was about to say,
like, look at the average length or size of candles going thing, like just like what a daily move is. We've never seen Apple in the last year have anything that reflects this kind of a percentage move in this short of a time.
Yeah,
this burst was a mega short squeeze, right? And someone was on the wrong side.
I think it was a combination. I saw some stats out of the Goldman Sachs prime brokerage report that showed that Apple is one of the Mag 7's largest underweights in terms of with clients. So, because you don't forget, Apple was the stock that couldn't do anything right. It had no AI. It had all this stuff. Everyone was short it for the longest time. I remember people, pitching me all sorts of bear arguments about Apple and how it was dead. And, hats off to Steve Eisman from The Big Short, because he's been calling this as one of the catch-up AI plays. And I don't think even he would have expected it to catch up so quick.
Yeah. It's an incredible move, and the interesting part is and one of the things I've been saying to my members of Big Picture is that when Nvidia peaks, I think that within a day or two will be the S&P 500 peak as well. Like I think this trade is almost defining the entire trend move, and it's such an interesting place to be. Anyway, so as AI moves, it's crazy. It's what's driving almost all the performance in the markets, and watching over the next couple of weeks whether the bulls can keep this momentum going or whether we have some sort of a blow off swing high come into a consolidation is for sure the thing to watch.
All right, so let's talk about the markets. What do you have?
Let's talk about them. So first off, S&P 500 holding along its highs, and this is the most interesting storyline in my mind in terms of where we are, because the S&P is holding up there. Now, I look at global developed markets, and I usually like to identify whether they're correlating or not. I like to see whether or not the sub-indices like Russell and NASDAQ and Dow and other things are confirming. And what we have is an S&P 500 that is literally holding up along its highs. And at the same time, and by the way, and the NASDAQ, of course, is doing the same, up right along its highs, driven by that. But this is simply not being confirmed by any other type of an indice, whether global indices like the Nikkei or the Eurostock, which actually, let's pull up the global indices. Like the Nikkei has peaked out already back in March. And simply has not been able to participate in any way. It's just been pinned. It's not bearish, but it's simply not participating in any way. And the Eurostock now put in a topping formation, and obviously the French market is dragging this thing down. And so we have a scenario where a lot of the other developed markets in the world have stopped participating, and in fact, in the case of Europe, have already started to sell. And the interesting thing is, and then we look at the real market in the U.S. and let's take that equal weight S&P that you were just referencing, and the equal weight made its highs back in March. The retest in May did not make it to the previous highs. And this entire last rally that was driven by NVIDIA and Apple, the equal weight index has actually down in this last 2 weeks.
Yeah.
And so you can see that on the equal weight. But then you take the Russell, which is almost at a 1 month low, and a stone throw away from its April low. And I'm going to even talk about that index that I'm going to give you an opportunity to shit on me for, because it's your famous thing. I'm going to look at the Dow Jones here. Go ahead, do your little piece.
No, I'll let you.
Worst index ever, right?
I
Just
don't
go on,
know.
say it. Anyway, so, but the interesting reason I like to track it, Kev, is it's price weighted, not market cap weighted. And so you don't have the same influence or drivers that these behemoth stocks that are driving everything. The Dow simply isn't going to have the same kind of fuel dumped on it from those huge market caps on those main indices. Point is, the Dow double topped, and this entire rally is creating a flagging formation, like if it's ready for a bearish breakdown.
It's the kind of sell everything except those 3 stocks and buy them market. And that's in essence what's happened. There's nothing going up. Like some of my buddies, they're telling me, they're saying, I get up every day and I go and look at my screen and like almost all of it's red except for those 4 stocks or 5 stocks.
Absolutely. And the interesting thing is, okay, so S&P 500 literally is like within 10, 20 points of its highest intraday print. And if it closes here, this is going to be the highest close that it's had. No, actually, it closed higher yesterday. But still, the point here is we're literally within points of closing near the all-time high. And when you look at the breadth of the market by looking at the percentage of stocks that are above their 50-day moving averages of the S&P 500 stocks, we're at 43%.
Yeah.
That means 57% of S&P 500 stocks are downtrending, outright downtrending.
It's absolutely crazy. It is a very, very unusual market.
And this is where I think that this is an absolutely valuable time to really assess, how you want to be positioned in these markets. And the interesting thing, Kev, like I'm doing a special webinar on portfolio hedging, and I think that this is such an interesting moment to actually put it on, because there's at some point. NVIDIA and Apple are just like when you shoot a rocket up into the sky. At some point, the fuel runs out, and it's just and under its own weight, it will just mean revert. I don't want to say anything bearish in terms of like it's but it's going to mean revert. It just can't keep going parabolic without at some point correcting. And when that happens, that's probably going to spur a much bigger stock market correction. And the crazy part is that right now to buy portfolio insurance is still ridiculously cheap.
It is crazy, isn't it? Like there's the fact that here we go, and it's actually when people are the most bullish, they're the least interested in buying insurance, and yet it's when it's the cheapest, and it's when they should be buying the most likely to buy it.
Yeah.
So Patrick, before you go, I'm gonna before you keep going about this, when is your webinar?
So the webinar is on Tuesday at on June 18th at 11 a.m. and you could just go to bigpicturetrading.com to the website, and it's right on the homepage. You can register for the webinar,
so
and if you can't attend it live. Completely free, and even if you can't attend it live, the recordings is sent out to all registrants, so you'll be able to see it no matter what. And so I wanted to just touch on why I think it's such an interesting thing at this moment. So, Kev, this is the chart of the 1 year volatility index. I'm going to put it actually on a weekly chart. And we're not talking about hedging with a 30-day option, like the 30-day VIX The standard VIX index is just telling you what hedging for the most immediate downdraft is, right? But if you go and just do portfolio insurance farther out, it has not been cheaper from a vol perspective to buy a downside protection since COVID. Like this is the cheapest it's been in almost 5 years.
Right. And then when you combine that, there's also another reason in terms of as a percentage of the underlying, it's cheaper than before COVID, right?
Absolutely, and absolutely, and there's a second component which I'm going to be talking about in the webinar is the fact that interest rates being as high as they are, because the Fed hasn't started cutting yet, means the forward price of the S&P is higher, making the at-the-money put options actually that much cheaper. And that's a concept that we'll explain in greater detail. But it's like literally right now, the biggest issue always is that everyone might think that it's a time to do some selling, but there's always challenges to selling, whether it's tax implications, trading restrictions, or just in the complexity of doing it. Why so many people often simply stay invested because it's just too complex. But overlaying insurance means that you don't have to do any of the selling. You just need to position yourself that you have that tail risk insurance that reduces the volatility of your portfolio and allows you to hold through things like this.
Got it. So Tuesday, June 18th.
Tuesday. Shameless plug. Thank you, Kev. The
Big Picture Trading.
One thing,
Make sure you go check it out. Completely free.
But the one thing though, Kev, I wanted to segue that into this conversation about the pain trade. A lot of people today are the market's it's an election year, it's this, it's that. Everyone comes up with a reason when the market's at its highs why it can't go down. But the thing is that back in 2023. There was no shortage of bears anchored off of the regional bank crisis and the yield curve steepening, and there were
reversing. Not steepening.
Inverting. Inverting, yeah. And like it started to revert back to being positive from an inversion.
Oh, I see. Okay. I didn't understand that.
That's because it was deeply negative, right? Okay. The twos, tens.
Yeah, I hear you.
And so the thing is that everyone was bearish. Everyone thought everything was going down. But the one thing that I've learned from 20 plus years of trading is the market never crashes when people are planning on it.
Yeah.
It's like the one rule that you can live by is that if everyone plans on something or expects something to happen, it never does. And it's the idea of the pain trade, which that the market will take the path that causes the most discomfort or financial pain to the largest number of investors. You basically need, in order for there to be a liquidity event or a market turn, you literally need everyone on the wrong side of the trade.
Well, we're getting there.
And all together on the wrong side of the trade, and they all try to run for an exit door at the same time. And the thing is that when I look at compared to the regional bank crisis and all the other stuff last year and how everyone was positioned versus how everyone's positioned today, I can't find anyone who's excited about being short.
Oh, I completely agree. So I can tell you, Patrick, I used to go and try to say the economy's not so bad. Everything's going to be, it's not going to be as bad as you think it is. There's the fiscals, is way stronger than you might expect. And everyone kept telling me, you don't understand the yield curve. You don't understand this. You don't understand that. And now when I start saying, listen, things are kind of frothy, you should be thinking about the other way. People just tell me, no, it's going to keep going up. There's no reason to fight it because it's going to continue forever. Yeah. And to your point, like rockets, they don't, go forever. They eventually fizzle out. And I think that the bigger issue is the fact that there's so many of these just absolutely insane stats that you're seeing in terms of whether it be the concentration of those three names, I saw that Sentiment Trader had this post the other day in terms of he called it the information ratio, which I believe is against a benchmark. So I'm confused why he would do the S&P 500 against an information ratio. But in essence, if you look at like a Sharp for the S&P 500, meaning the returns adjusted for risk, we've almost never had this sort of rally. This is the kind of rally that is hugely overbought on a risk adjusted basis.
Yeah, it's absolutely insane. But you know what? It still can continue. Like, I mean, it's not like me and you are here saying that today is the top, right? Like, it could be at 5,600. Nvidia could be at 135. Apple can be at 240. And this can be the story 2 weeks later when we're recording the next huddle that the market is still up along its highs.
Nvidia is going to be
Like,
135 this afternoon, buddy.
That's no shit. The way it's going, it's the. But what is interesting about it is that it will at some point peak out. We don't know that it's going to happen now, but this is the whole point of insuring yourself. Right? Anyway, I'm not going to go back on that. Anyway, I wanted to touch on a couple other things.
Actually, before you do, can we just talk about the one thing that Bob Farrell's rules? I always think about this: exponential, rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. Just remember that when you're buying NVIDIA up here.
I love it.
All right.
I love it.
Okay, what do you got next?
All right. The asset that should not be named.
Oh.
The interesting. Listen. We'll just analyze it without talking about whether we like it or don't like it, and on a basis. I want to just technically talk about it.
We are indifferent to it. We are looking at it with the passionate eye of a technician.
Okay. Exactly. And so we have a scenario where it has now tested these highs numerous times. It's still in a bull trend. And nor do I will say anything bearish on it yet. But there's using a nice thick crayon, there's that nice trend line coming up right into a Fibonacci zone. This 65,000 is a 50% retrace. And this is just the line in the sand moment. If the bulls are in control, and Bitcoin is destined to go higher, this is a very tactical place to be looking for the swing low for a continuation pattern higher. And so because the bull trend is the dominant one, you give the bulls the benefit of the doubt that they're going to that this is going to work. But I'll start getting bearish if they can't. If you come to a tactical buy zone like this and the buyers don't show up, that's in itself bearish. It means that there's no marginal buyers left. So the point here is that this is actually a huge pivot for me on Bitcoin. Right now, the bulls have been in control. The bulls, it's still a bull market. It's still a bull trend, but we're coming to a very important line.
The only thing I'll say, if I'm putting on my pure technician hat, the only rule I really believe is there's no such thing as quadruple or quintuple tops.
Yeah.
And it looks like it has to go higher.
You know what? I would not be shocked by a prairie dog, which is like this thing rips to 75,000 in one quick pop and then right back to 65 and just. So
you realize both of us are not shitting all over Bitcoin and even saying that from a technical basis, it's probably going to go up. So that is,
which means it's going to go down.
This thing you guys should short it with both hands.
Now we're really in trouble. Yeah. Because now we're going to get blamed.
Whenever I get on the show and they start talking, and I get a Bitcoin kind of enthusiast asking me questions, I always tell them, listen, the last thing you want is me to turn positive on Bitcoin because that's going to be the top. So maybe this is it.
All right. So let's punch through a couple more charts. Gold, it's still a muddle. It's in a corrective pattern. It could continue to correct sideways. It might even go down to 2250. I remain bullish gold in the big picture, but we had the bull impulse. The market went 2 steps forward, and now it's taking 1 step back. And in this situation, gold's in some sort of consolidation. Question is, how long does it stay in this consolidation state before another bull advance begins? I still think there's vulnerability for a little more downside, but I think that it's still a tactical buying opportunity when that gets it to cheaper prices.
Okay, what's next?
Crude oil. I thought it was really interesting how crude oil had the complete dump at the end of May, early June, and surprisingly completely reverses the 5 days of selling. And that, to me, that's the real fair value zone of oil is much closer to that 78 to 80. Some sort of liquidity event caused that short-term spill, and at this juncture, it's coming back to a neutral zone. But what's interesting is that gasoline hasn't joined the party yet. And to me, I like to see gasoline and oil confirming each other. It's sort of like it's nice to see gold and silver sort of trending at the same time. And the fact that gasoline is continues to kind of tread water, it makes me not want to trust the short-term reversal in oil. I still think that oil ultimately is going to have a great bull run at some point, but really at this stage it's about fishing for where do we see bottoming formations where the pattern shifts to genuine accumulation and a new trend potentially turning. And I think it's still a little early here.
Okay, I like that.
You have an opinion?
I
on
don't
that?
have an opinion really, but I like your analysis.
All right, so let's touch on copper. Copper was one of those things where the sentiment couldn't have been more bullish a month ago.
By the way, I noticed that you guys on that podcast you cheat on me with, that you guys had Jeff Curry on there. Did Eric ask him about the trade of his lifetime?
Oh shit, I don't remember.
Because Jeff Curry top ticked this, and I like Jeff Curry. He seems like a nice enough guy. But whenever you start talking about the trade of your lifetime, especially on national TV, market gods are going to punish you. They're just going to be like, they're just going to punish you. Like, there's just no way that's going to not go unpunished. And sure enough,
he likes oil more than copper.
Well, okay, so that means oil's headed lower. Because the reality is that he top ticked this, like literally almost to the day. He was on Bloomberg talking about the trade of his lifetime. And you just don't do shit like that. Market gods don't like that. When do people learn?
Just shut the fuck up.
Well, you can have an opinion, but it should be respectful. And you should realize you can be wrong. And nothing is the trade of your lifetime.
There you go. All right. Let me just see if there's. We got to talk bonds.
I was too busy, giving you a hard time about your other podcast. What do you think of copper? You didn't tell us.
Whenever you have this kind of a parabolic rise, and it corrects, and it's doing so, but typically there's some sort of a retest. Now, it doesn't have to be a double top retest, but as we approach this 440 area, I think there's room for us to get back to 475, 480 on a reaction higher. And maybe it goes for a full double top retest. I don't think that this is the moment where we have a $6 run on copper, but a retest of the highs somewhere in a short-term bullish impulse, I think can happen here.
I like it. I think it's headed high. I think it's a bull market, and even though I'm giving Jeff Curry all the hard time for his call, I think the reality is it just got a little ahead of itself. I think we go sideways, chop around here, and that still we're headed much higher.
All right, now Kev, I'm gonna make you puke in your mouth a little bit here. I'm bullish bonds.
Oh, really? I'm surprised. That's very unusual for you.
Listen, I am not looking for a new bull market in bonds. I'm just a tactical bull trade in bonds. So I have here the 30-year. And I'm going to put this like on a weekly chart so we can really see that devastating 40% wipeout that made you a small fortune. But obviously this was one brutal bear market decline. What was it, like a 40+%? What was it, peak to trough? It was 44% decline on this T-bond futures. But from this oversold state and where we are in the economic cycle, where we are in all of this, I don't see why this long bond can't go and retest levels of 2023. And that in itself, like, let's just say that we had a rally up into these zones. That doesn't mean you won't be right that this thing is going to be down at 100 in 2025. Right? I'm not like looking for a new bull market, but I think there's a tactical opportunity here to play bonds for a kind of like a 3 to 6 month advance going through the end of the year.
Okay, so here's what I'm going to say to this. I don't hate your trade, but I think that there's a better way to play it, because I do think the economy is rolling over and that the next move will be market participants going, oh my goodness, actually look at it. It's not as strong as we thought. Remember when we were talking at the beginning of the year and the market had priced in 6-7 cuts?
Yeah.
I think that if we had a situation where the market, the economy rolled over, we could have those 6 or 7 cuts being priced right back in. And
Right.
if that is the case, I suspect something like the TUA or like levering up the front end will do better than owning the long end.
By the way, I do own both with members of Big Picture.
Okay.
So we're in the TUA, but I think they are different trades because the TUA is really about when they price in how many cuts in the next couple
I
of
agree,
years.
but I think that the market will run way ahead of the Fed, just like they did the last time. So you're like,
listen,
judging
I love both of these. I have both of them, and I'm not going to complain. I like what you're saying, and I've already put it on, and so it's not going to work. We're both in it. But
I really do
but,
believe that the long end might surprise folks on how it behaves, and then it might not do what everyone thinks it's going to do.
You know what? I wish we should restart up our betting game.
We should figure out a new betting game. But
yeah, because I would wager that I would bet you that the TLT is going 100 plus. I think we're going to see 100, 105 on the next impulse.
You listen. I'm not
right?
saying
Like, I'd love
I'm
to
not
bet.
saying you're wrong, but I'm saying that whatever that move is, the TUA is going to do better.
Well, you'd have to size the trades differently.
Well, no, because the TUA is actually the TUA is duration weighted for a 10-year. So if you gave me a 10-year, we'd have to make sure that there was the same duration.
Look, you're talking 21 to 24. You're talking just over a 10% advance, right? Like even if this thing went back to 2023 highs, you're talking about a 10 to maybe 15% advance in it, which is, by the way, very good. I'm not saying that. A TLT at the same time going 105. Yeah, I know it's the same shit. Yeah. It's the same shit.
I just think that from a risk reward basis, the TUA is a better trade.
They're both both of them I think have a 10% upside.
Well, okay,
from a bond perspective, but that's definitely in my mind the thing to watch. What I also want to just touch on, I still can't wrap my head around how well junk bonds have behaved. The high yield market seems completely resilient.
Now, having said that, I completely agree in terms of the past. Over the last couple of days in Europe, we're starting to see some real widening in credit. So it might have started, Patrick. It might have
started. And that's so I'm curious. We should start tracking on the show here every 2 weeks, just looking at the junk bond credit spreads and see whether or not we see a trend shift in that. I think it's certainly one of the more interesting things to watch. The one thing I wanted to just wrap up things with is I wanted to talk about China. And back a month or two ago, let's say even over the last 6 months, there was an incredibly large amount of people out there wanting back in on the China story. I never drank the Kool-Aid. I'm more neutral. I don't want to say anything outright bearish, but really, the China story died over the last month. I don't hear anyone talk about it anymore. Do you?
No, you're right that it's gotten kind of quiet.
It's gotten very quiet.
Yeah. But let's face it, everything's going down except for the top 3 U.S. stocks.
Yeah.
So the fact that there's not people aren't excited about it isn't really that surprising.
Okay, but look at this chart on China when you go on a weekly and pull it out to the last 5 years. This thing looks like it's heading right back to the lows just based on the lower highs, lower lows channel on the downside. We have not seen anything bullish yet in China from a technical perspective in my mind.
Well, you're probably correct there. It was a short-lived affair. And the only thing I really had.
Well, look, I don't want to put nails in the coffin on this thing. I'm just saying, like, people think that they're grabbing alpha by going out to China, but I'm still in the same camp. I think there's so many things to trade, so many places to go. Why add geopolitics as a variable that when you can trade so many global markets and that don't give you that geopolitics
it's one of the cheapest markets out there.
It's cheap for a reason.
Yeah, fair enough.
Russell Napier tells you that,
No,
right?
agreed,
It's
but he also told you that almost all major markets bottom around 10 Cape. And, then he goes on and says, well, guess what? That's where China is, 10 Cape. So he's kind of...
China's going to 0 Cape.
Well, that's his, that is his argument, is that you have that risk. And I just think it's funny because...
he's my new Lacey Hunt.
Yeah. Before Russia happened... nobody ever even considered those things. My point is that if the people that are saying you can't buy China because of they're going to invade Taiwan, they should stop and think about the fact that NVIDIA, which might be the world's biggest company, depending on where it closes today, NVIDIA is almost, 90% of its chips or something is made in Taiwan.
Mm-hmm.
Right. And so what is you can't have one company priced for perfection. Everyone owns that. And then say, no, we can't own these other things because China's going to invade Taiwan. There's a paradox there that doesn't seem to make any sense. I think it's one of the most wild things out there.
I'm with you, bud.
One of them is wrong.
I'm with you.
And I'm willing to say that, maybe it is that Chinese stocks are cheap because the reality is that they are going to do that. But if that's the case, then watch out, because look what's going to happen in NVIDIA. I just don't, when I think about it, I think that all this Taiwan talk is overblown. I'm in the geopolitical camp that they're not going to do that. They're just going to wait their time out, wait. And then there won't be a single bullet fired. And, 10, 20, whatever years from now, it'll just get to assimilated, and there won't.
I agree with you in some degree or another. I think that there's a whole number of paths that can go. I think that always in modern, there's so much risk to a hot war that they have to exhaust every strategy that was possible to avoid the hot war till the hot war is the last option. And there's so many things and so many ways to accomplish it without the hot war that the hot war should still be an outlier in terms of thing. But it's still geopolitics. It's still a risk. I just don't like it.
I hear you. But it's just if you don't like that, then you shouldn't like NVIDIA. You shouldn't like Apple. That's my point, is that people they underestimate how intertwined the American economy is to China. So they'll say you can't buy China because there's so much geopolitical risk, and then they rush into Apple and to NVIDIA. The two top stocks are very dependent on China and Taiwan.
Yeah, crazy. Anyway, I want to wrap up today's session by talking about Roaring Kitty.
Did you watch it?
No, did you?
I did. I couldn't believe it.
Oh, you really have nothing better to do in your life.
No, the guys on the desk were watching it. So we put it on, and I'd seen the movie, and I knew he was a different cat. I knew that he was a little bit strange, but I was wholly unprepared for how useless that presentation was. Did you watch it? It was.
I didn't watch it, and I'm not going to. I'm not going to.
It was absolutely ridiculous, and I kept saying, I hope to God this is the top in the market, because I would love it to be the Roaring Kitty kind of Emperor Has No Clothes top. And the thing about this stock is that it's not a cheap stock anymore. And it's not like there's a huge short.
What did he buy? $65 million of at the money options that expire
this week,
this next Friday.
Was it next Friday?
On the 21st.
Oh, okay,
on the 21st.
The guy was a billionaire. I was watching it, and he was down $250 million the day when he was doing his presentation, because they had done the at the market deal. They'd plugged it with 75 million shares. So the stock had been 65 that night or something. And it was 30 or 25. And the reality was he was just sitting there like he was like high on drugs and talking about woo. And I'm like, the guy, you're like, I'm not expecting him to be all broken up, but like to be so casual about $250 million, it almost just, it felt surreal.
You know
like,
what?
It felt like it couldn't be real.
There are people out there that are that just literally view money as a video game. Like it's
maybe, but like
they just disassociate value to it, and they're just desensitized to any movement. To them, this is just playing a
like
game.
$250 million is a lot of money, even for like Soros and Stanley Druckenmiller. Like it's a bad day. Anyways, I just think it's the craziest thing I've ever experienced. It was surreal is the only way to describe it.
But what is crazy is that, you know, like we have seen this on numerous occasions, and it seems like they just keep coming back, and he just unbelievable.
What I would love,
anyway.
So Patrick, they did this big deal, this at the market deal, and they issued 75 million shares at $30 or something, or $40. Who knows what the number was? I would love to see them go and actually, like, let's imagine we did get a sell-off in the stock market and this thing came in, and next thing you know, it's $10 and they could do a buyback. Would that not be the funniest thing in the world? If they issued 75 million shares at like $40 and then a month later did a 75 million buyback at $10.
It would make them rock stars.
It would just be the most unbelievable trade ever done.
Well, when you've got like you know, the thing is that in the markets, often you have to hold your cards close to your chest, and Roaring Kitty is playing the opposite, where he's playing with his cards open to everyone, hoping that he creates a sentiment shift that feeds back on itself to make him that much more money. But often when the people, it's sort of the same way when Bill Ackman announced his Herbalife short. Once everyone knows you're cornered, then the big money comes in and says, we're going to fuck you.
Yeah. But you know what? It's easier to go after people when they're short. When they're long, it's harder. Like if you have stock and it's all paid for, the worst you can do is just have it go to zero. Right. And so when you're short, you actually have unlimited liability. So it's a much easier game to play when there's a short out there.
So, okay.
But having said that, those options,
his strikes, was it $20?
Yeah, I think it was
$20 calls that expire next week. So what's your over under that it closes at 20 on Friday?
Well, I suspect he's just going to roll them, like he's going to sell them. So let's say he sells them for, what are we trading right now? $28. He's going to sell them for $10. And then he's just going to buy new ones, like outwards.
Okay.
But the point is, that's going to be a delta. That's going to be a net delta sale in the market.
Yeah.
And that's the part that people don't realize. He won't be able to maintain that delta.
The same size.
Right.
Yeah. He's going to have to resize or go higher.
Yeah. Either way, whatever.
Well, he's going to give up intrinsic value because you're exactly right. He's going to give up intrinsic value to roll either at the money to keep it the same cost, or he's going to have to stay at the same strike and pay up.
Either way, the deltas go down. He has to sell deltas.
Yeah, agreed. It's listen. Let's make a note to talk about this 2 weeks from now when we see what he does.
Sounds good.
All right. Anyway, Kev, is there anything else that I forgot to mention that you think? Oh, the Bank of Japan. Let's just touch on this. It's interesting that the market continuously, like, you know more than I do on this. Is it the consensus out there that they're defending this 158?
They haven't done anything. They're worried. People are worried that they're there. By the way, so we have a good friend. I have a good friend.
Yen
I have
Whisperer?
a good friend. That's my
Yen Whisperer?
Yes. Well, he's my FX Whisperer. And he called me up. He sent me a note the other day.
Can I make him my FX Whisperer too?
He called me up. He sent me an email the other day, and unfortunately, I was going to talk to him about it, and I got some personal things came up, and I couldn't make it. But he said, if you're not long yen, get long yen. And he's not like me, like a stupid bull that's just been wrong the whole way.
He did that before the BOJ or after?
No, he did it like last week.
Okay, so you did it into the meeting.
No, but like,
and he's eating
like,
it.
Well, no, like it's basically hasn't gone anywhere in a week. Well, maybe it's up a little. Like it's basically this is noise.
No,
I consider this
on
noise.
an intraday basis.
Okay,
It was.
maybe, but that's noise. Like he's not playing for 1 yen. He's playing.
I get
He's
it.
playing for 10 yen or 20. So, but the point
My
is,
only pushback on that trade.
He's my whisperer, and he's never done this to me before on the yen. Usually, he trades euro or the dollar. He's never done this on the yen. I actually got to remind myself to go talk to him again because I don't know why he became this way, but he's like, buy the yen.
For me, my only pushback there is that if for whatever reason we have a little run in the US dollar, it might just be against the broad basket of all cross currencies. And that doesn't necessarily mean there has to be a huge rip in the US dollar yen, but it may push forward the timing of when a yen rally might occur. Like we might see a scenario where this thing just grinds towards 160 and then back and bounces around between 157 and 160 for, let's say, the next 3 months while the US dollar is ripping against the euro. And then when we line up for a bigger turn is when it will work.
Maybe. But I'll tell you this, Patrick. So many people are short the yen. I think if you got like an out of consensus rip in the US dollar, that it actually might also mean a rip in the yen. There's so many shorts out there. It's one of the biggest positions out there in terms of the carry trade. Like just dial, for example, Mexico, Japan, which was a very popular carry trade. And you can see that thing's come unwound. And we're seeing more of these sorts of VAR events. Like, and I could see a situation where there's other things that cause the yen to go bid and come unwound against other cross currencies.
Yeah.
So although I understand your argument that the dollar might suppress it, I think that in a scenario where we actually had a true risk off event and the US dollar was ripping, that the yen might rip as well. Like in the old days, that's what used to happen. Remember, the yen used to be a safe haven currency, and you'd actually have the yen going up as the stock market went down. These past couple of years have been quite unusual in terms of the yen as actually being a driver, the other way.
Well, we live in interesting times. I think there's going to be lots of market moves in the next year and some big opportunities. So let's see how it develops. But that's all I got for today, Kev.
Okay, well, thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Patrick, where can they find you? And give us again the date for your big show.
June 18th. Tuesday, 11 a.m.
Eastern time,
Be
right?
there.
Eastern time?
11 Eastern time. Be there. And if you can't, you'll still get the recording.
That's
Just
right.
go
Sign up and you can get the recording and watch it at your leisure afterwards. Bigpicturetrading.com. And listen, you can find me at kevin@themacrotourist.com. We can never have too many friends. Bear market, bull market. We're just happy you spent some time together. Now stick around for the after show. Okay, Pat.
Daniel.
Hello.
Daniel. This beer is fantastic.
You like it?
I do.
Good.
Why I've never drank this before, I don't know. It's not cheap for Portugal's beer.
No, it's,
Like it was €3.
yeah, it's from
Like literally, you can have a 6-pack of Superbock for one of these. But
So give us a rating.
for real.
Like,
No, like on 8.8.
Whoa.
This is great.
Jeez.
That's high
And
for me.
is that a,
I've only ever given a 9 handle.
is that a Portuguese beer?
No.
It's a British
That's,
beer.
no,
German?
It's I think it's German, yeah.
Ah.
Yeah.
Or it's
It's
from that area or something, maybe.
That's the one thing. Germans know their beer.
Yeah.
No, but the thing is the craft industry and IPA industry. Maybe I don't know what the scene in Germany is on those, but when you're talking mainstream beers, it's just fantastic.
Yeah.
They brew some really good, nice, clean beers.
Yeah, all that part
It's-
of Europe, Austria is really good too.
Yeah.
Oh yeah, they know how to drink beer.
Daniel, are you
The
all set up
Czech.
in Portugal now?
Yeah, I'm here now.
Are you enjoying it?
I mean, coming from like 15 degrees in England and then coming here when it's like 30, 35 every day, I mean, can't complain really.
Can't complain. Does your dog
Can't
complain?
complain.
Does your dog think that he's like, go back to the cold weather?
Nah, she's having a great time.
Oh, that's good.
You know, I'm going to the hottest city in all of Europe this weekend.
Where are you going?
Cordoba, Spain, which is just outside of Seville, but it's the hottest spot in all of Europe.
Really?
How?
In terms of temperature. Like, they regularly are 40 plus in the summer.
Why are you going there? What's the attraction?
I just wanted to check it out. I mean, it's
Are you driving,
it's
or are you
driving
gonna fly?
distance from. Yeah, I'm driving. It's just outside of Seville, so it's like a 5-hour drive.
That's
Portugal
Uh,
is foreign.
Right, and so like I just want to check out Spain as much as I can from here, and so like that was one of my little road trips I wanted to do. But yeah, I'm gonna check it out. I'll send some
Well,
pictures.
you should, and another road trip this summer. You should do the Gibraltar monkeys.
You know, the monkey. What?
There's monkeys up in the mountains there.
Really? I did make the drive to Gibraltar. I just never crossed the actual border. So I was all along the coastline there without actually
I can't believe you went
crossing
that close and
passports.
you didn't go and see the monkeys.
Yeah, amateur
It
hour.
was. You got to go. Have you been?
Really?
Daniel?
I haven't, no, because even though it's part of the UK, I haven't ventured all the way to Gibraltar. No.
Oh, can't believe you guys. Go see the monkeys. They're awesome.
Oh, listen, it's gonna happen. It's gonna happen. It's close enough. That's all the fun parts to explore.
All right. Okay, I'm going to let you guys go. Have a
Yeah.
great week, everyone, and we'll see you in a couple of weeks.
Cheers, everyone.